Let us begin now with these markets. And Guy Adami, I've got a statistic for you that I think might move you on a Monday, maybe to tears, given the kind of weeks that we have had. Here we go. With today's move up in the NASDAQ 100, the QQQ, well talked about on this fine program, is now higher year over year.
I mean, it's amazing what you can do with numbers, and that's I didn't know that, and thank you for sharing that, and happy Monday to everybody, and this is a good day, and I think you can take some glimmer of hope from that, absolutely. You know, I think Tim's joining in, and he's been optimistic, which has been good. I think Dan and Karen have as well. I think Dan has a longer view that he will share about where the market is headed. You know, I've said for a while, and I don't know where the market's going. My opinion is, and I'll share again, that I think the move is not done until we hit 2790 or thereabout in the S&P 500. Given today's close, that's about a 5% move from here. In terms of the math, that makes sense given the recent low of 2190 and the all-time high we saw just a couple months ago, 3393. That's effectively a 50% retracement. It makes a lot of sense. I think at that point, my opinion, you have to be looking to pare down risk and take some money off the table, because despite the fact that the Fed appears to be buying everything, and you mentioned Janet Yellen at the top of the show, you know, I don't know that this is over as quickly as people want it to be over, Brian.
Yeah, and Dan, Nathan, nobody is saying that everything is fine. We're dealing with a humanitarian crisis of unprecedented proportion in the modern era. But from a market's perspective, I would imagine there are a number of smart people out there watching CNBC who are thinking, wow, is this the start of something else, or should I be selling into strength?
Yeah, I think that you just mentioned that we have an unprecedented health crisis. We also now, because of the steps that we've taken to mitigate that, we have an unprecedented economic crisis. So if you're looking at the stock market as a lens to see if we fix the health crisis or we fix the economic crisis, you're looking at the wrong thing here. I mean, I think that the fact that the stock market is up 7% today because we finally got some good news on the health crisis, that's great, okay? But to make some assumptions about what the market's going to be doing from here on out based on what we think is going to happen in the economy, I just think is the wrong move here, especially when you think about 6 weeks into this market sell-off. It just doesn't make a whole heck of a lot of sense to me. We've talked about this again and again, Sully, over the last few months or the last few weeks at least, that 20% rallies in bear markets are features. They are not bugs. We had 2 in 2001. We had 2 in 2002. They both failed. The market had a peak to trough decline of 50% in 2008. We had 2 peak to trough declines or rallies off the lows of 20%. They both failed. We didn't bottom until 09. So if you think that this unprecedented health and economic crisis is going to be encapsulated in a month-and-a-half decline of 35% peak to trough decline, you're just not paying attention to history and you're kind of doing it wrong. So get geeked up if you want. I just don't think you should be buying on a day like today. We may get to guys 2790, but I suspect we fail, and I suspect it's going to take some serious time for us to work out of this health and economic crisis.
Okay, dose of reality there from Dan, Karen Finerman. Listen, again, the tape looked nice for a lot of people. It's a respite. We're not throwing that under the bus. But when you look at the internals of this rally, I'm looking at the numbers here. The top 20 or 30 S&P companies are all down 40 and 50% this year. Kind of a lower quality type rally. At least that's my view. What did you think of it?
So I hate rallies like this, actually. I agree with Dan. I would not be buying on a day like today. I'd much rather be buying in a big, down, ugly day when things are just trading down in integers. Today was the opposite of that. It was just things trading up in integers. And so that is obviously good news on the corona front, hopefully. It's early, but hopefully. So that is good. But we have no clarity on the economic front. And even if we start to see numbers early April, for the March quarter doesn't really capture a lot of what is going to be the bad news in the economy. So that has me worried. This kind of rally, I didn't buy anything today and just shorted some spiders at the very end of the day on the close because I think this was kind of overdone.
Yeah, and Guy Adami, again, we're looking at the VIX here. One of the things that you like to look at all the time, It did fall today. It's still at 45. I mean, if we had a 45 VIX 3 months ago, we would have thought that the world, had gone upside down. Maybe it has in some ways, I guess. Did the internals of the market make you at all skeptical, kind of like Dan and Karen?
Yeah. Yeah, I think you bring up a good point, and it's worthy of a conversation. You would have hoped on a day like today, if you had asked me on Friday and you said, Guy, the market, the Dow, the S&P is going to be up 7% or thereabouts, where's the VIX going to close? And I would have said, given what you just said, below 40, hopefully maybe 37.5, 38. And quite frankly, it really didn't budge today, which is somewhat problematic. And I think that speaks to exactly what Karen and Dan are saying. Listen, I want to be optimistic. I absolutely do. But to Dan's point, we don't know what the consumers, when you're talking about an economy that's 73% driven by people buying things, to think that all of a sudden magically, when this is hopefully over and soon, that people are going to go back to doing what they were doing, I think is somewhat foolish. I think consumer behavior could change fundamentally. I hope I'm wrong. I just don't think I am in this environment, Brian.
So just let me add something on the VIX, which normally we talk about it when the VIX goes up because it's sort of we use it as a proxy for fear. Really what the VIX is sort of a mathematical model of how much the market will move in the next 30 days. So now we should really think about it as a thrashing around model. So today was a thrash to the upside. The VIX didn't come in. I think the healthiest day we could see is a flat day. That to me would be much healthier than these giant up or down days.
Yeah, and again,
I would just say
Dan,
that
you look at the small caps. Go ahead, Dan, jump in.
Yeah, no, listen, the small caps I think is a great thing. That's where you're going with this here, Sully. If you look at the chart of the Russell 2000, today's 7% or whatever it was up, that move looks like a blip on a chart of a indice that had a peak to trough decline of 40%. I just think that when you go back and you think about what we're trying to do here, we're not your hedge fund manager. We are not your stockbroker. I'm not your investment advisor. We're here on TV. We're talking about the 2 decades plus experience that we have in dealing this stuff. And, it was pretty easy for a while when all you had to do was say buy the dip, okay, because it worked for a very long time. I think it's really important to understand right now, based on my 25 years in the market and Guy, your 30, 40 years, it is different this time. I want to take what I saw in the late 90s when I entered the business, the crises that we saw there, the long-term capital, the Asian financial crisis, the dot-com implosion, the financial crisis, which was a man-made thing here in America. And then I want to take the sovereign debt crisis. And then I want to take the China growth scare and debt scare in 15 and 16. And I'm going to wrap them all together, and I'm going to tell you that's what we have right here. I'm not trying to freak you out about the stock market. It already crashed. Commodities crashed. Rates already crashed. Now we have to figure out how do we work out of this. We front-loaded the response. We've basically thrown about $5 trillion at this. That's the entirety of TARP and all the other iterations of it in QE. And now we have to figure out how we come out of it as an economy, how we come out of it as our livelihoods, and that's going to take time. It took time all those other times. I don't know why we're rushing right now because the president wants to sign a stock chart and send it to Dobbs or something like that we think we're going to come out of it this way. That's not how it's going to happen. Be patient here, people.